We're at that point in the interest rate cycle where a cut in rates doesn't just mean go out and buy a house. It may also mean the economy's in a bit of trouble. The Reserve Bank kept rates at 2%, saying it wasn't going to move 2 months in a row, and future rate reductions will depend on the data that rolls out. Essentially, it wants to gauge the impact of previous cuts and observe what happens when the US starts putting up its rates and see how the Greek Eurozone issue plays out. If it all turns to mud, the RBA will cut rates. But the traders were looking for a stronger commitment to reduce rates in the future, and when it didn't come, the dollar went up. Even though the RBA said, yet again, the Australian dollar is still too high, words aren't enough, I'm afraid. We did get some numbers today showing the weaker Aussie dollar is helping. The trade performance has improved. Take tourism, for example. The value of tourism exports, which means tourists coming to Australia, is rising, while there are less Australians travelling overseas. That should make tomorrow's GDP numbers look a little better. But equity markets want lower interest rates, and the RBA announcement did not go down well, so the market went down as well. As you might expect, the banks got hit. Miners and energy stocks were also in the firing line, and weaker commodity prices took a toll. On currency markets, the Australian dollar held on to its gains, finishing the day higher across the board. And that's finance.